Greetings of the day. I, Dr. Raja Kamal CH, Associate Professor, Department of Commerce UG, Kristu Jayanti College, welcomes you for the today's section. In this today's section, I would like to give a brief notes about investment. So whenever we are going for an investment, it is required to check how much return we are going to get. It is quite common that all of us we focus on the return. I have invested 1 lakh rupees. After 1 year or 2 years, how much return I am going to get? We see on the return. How many of us we are going to focus on risk factor? Today, our topic is about risk factor that need to be considered before going for investment. In finance, risk refers to be the degree of uncertainty or potential financial loss. I have invested 1 lakh rupees. After 1 year, whatever the return that I got is 90,000. 10,000 rupees, whatever the financial loss that inherent in an investment decision that I have made is considered to be as risk. I can say risk as future loss. Estimating the potential future loss is considered to be as a risk. Generally, whenever we go for investment, we invest our money to raise our capital, to raise our funds instead of losing the funds. That is why it is required to us before going for investing, consider the risk factor also, whatever associated with the investment. In simple words, I can say risk is a difference between expected returns and actual returns. Again, if I want to tell you one example, as I said, I have invested 1 lakh rupees. I expected I may get 1 lakh 50 as a return. Instead of getting 1 lakh 50, I got 1 lakh 10. 10,000, it might be profit for you, but the expected return was more than the actual returns. That 40,000 is considered to be as a risk. In this example, if you notice, risk is not loss. I invested 1 lakh rupees, I got 1 lakh 10,000 back, 10,000 profit. But whatever the expected return was, 1 lakh 50, there is a difference between the expected returns and actual returns, that is 40,000 rupees, which is considered to be as a risk. So if you see the risk in financial terms, higher the risk, higher the potential returns. Lower the risk, lower the potential returns. For an example, I have 1 lakh rupees. Again, I have 1 lakh rupees. That 1 lakh rupees I have invested in fixed deposit in a government bank or in a post office scheme. We have different post office schemes are there. I invested my money in a secured place where the risk is very less and also return is less comparatively other investments. Suppose you invested your money in shares where the risk is high, at the same time the return is also high. That is why high risk, high returns, low risk, low returns. So this risk can be classified in systematic risk and unsystematic risk when it comes to the business point of view. Systematic risk, which is uncontrollable by any organization, whereas unsystematic risk is controlled by any organization. We know that business environment is going to influence by two environments. One is internal environment and another one is external environment. Systematic risk was connected to the external environment. Both systematic and unsystematic was connected with external and external environment, whereas particularly if you see the systematic risk, it's completely connected with the external environment, which is macro in nature. And that external environment also, which is not under the control of the business. Suppose For an example, any policy that was changed by the government, if I ask a question, will government gives the instructions to company or company will rule the government? So government will rule the company. Whatever the policy changes that was brought by the government, which is completely uncontrollable by the organization. This type of things are considered to be as a systematic risk. Uncertainties that is going to be taken place, act of God that is going to be taken place, all these are considered to be as systematic risk. Systematic risk is considered to be as uncertainty of an investment. It cannot be diversified because this systematic risk typically consists of caused by the macroeconomic factors, and it is called as a considered to be as a non-diversifiable risk. Some of the reasons for unfavorable conditions for the business in terms of systematic risk is like natural disaster, changes in the government policy, international economic components, changes in the national economy components. All these factors which are not under the control of the organization is going to affect the return. That is why it is considered to be as a systematic risk. Here are the few more examples I have given for your better understanding in related to systematic risk: tax reforms, interest rate hikes, changes in law, natural disasters. All these are the few examples for systematic risks. When it comes to the unsystematic risk, which is most of the 90% of the risk is under the control of organization. Unsystematic risk can be controlled, unsystematic risk can be minimized or even avoided by the strategies that is going to be applied by the organization. So unsystematic risk represents the asset-specific uncertainties that can affect the performance of the investment. This risk arises due to various internal factors and few of the external factors that affect the particular organization. The external factors also which are under the control of the organization. So unsystematic risk is considered to be as a controlled, minimized and even avoided by business strategies. So here few more examples for unsystematic risk: competitive risk, compliance risk, errors in the entrepreneurial judgment, strategy risk, outcomes of legal proceedings, reputational risk, investment risk, inheritance risk, liquidity issue. These are all few examples for unsystematic risk. So if you in detail, in brief, if you see the difference between systematic risk and unsystematic risk, systematic risk is associated with the whole market, whereas unsystematic risk is associated with the particular industry or company. Systematic risk is uncontrollable, whereas unsystematic risk is controllable. So systematic risk completely influenced by the macroeconomic factors, whereas unsystematic risk is influenced by the microeconomic factors. Two, there are a lot of organizations are affected in systematic risk, but in unsystematic risk, one specific industry or one specific company will be affected. To get the protection of unsystematic risk, being a business person, being a proactive action, what you can do, you can make wealth maximization, which is called as a through asset allocation or hedging. So to avoid unsystematic risk or to minimize the unsystematic risk, each individual company has to go with portfolio diversification. So few of the categories of systematic risk is interest risk, market risk, inflation risk. Unsystematic risk categories are business risk and financial risk. So this is the formula that what we use to calculate the risk. So we can use standard deviation, we can use variance, we can use expected return. All these are the different formulas that we can use to find out the risk and return. In the next section, I will come with a very wonderful problem. Thank you for watching.